Hi everyone. By now, you should have a good understanding of the two types of options contracts and the four basic strategies: long call, long put, short call, and short put. However, the advanced strategies involve combinations of two or more of the basic strategies. Accordingly, these are called multi-leg strategies. We'll explore these in today's episode. But single leg calls and puts are only the building blocks of option strategies. So as you know, there are two things that you can do with options. You can go long, which is basically buying to enter, and you can go short, which is selling to enter. And of course, you can buy or go long on a call option, which looks something like this: limited risk, unlimited profit. And you can also buy a put, which is again limited risk, unlimited profit on the other side. On the short side, you can short a call, which looks something like this in terms of a profile. You have a mirror image of the long call, and likewise you can short a put, which looks something like this. Now, these only form as I said, the building blocks of option strategies. And we can create multi-leg strategies by combining these options, long calls and puts, with different strikes and different types, different expiry and the likes. Okay, so the combination of these simple single leg options creates the control that we look for in option strategy or through option strategies. So we can define our risk and increase our potential profit by using these combinations of these the single leg strategies and converting them into multi-leg strategies. Now, before we go forward and really explore multi-leg strategies, I want to talk to you about a trade-off that exists as far as trading in general is concerned, but also definitely as far as trading in options is concerned. And the first trade-off is between risk and profit potential. So as you increase your risk, you tend to increase your profit potential. So, or put it a different way, to increase a profit potential, you need to increase your risk. And likewise, as you decrease your profit potential, your risk also decreases. So that's the first trade-off. Something to keep in mind as well is that balance between the profit potential and your risk. The second trade-off is between the profit potential and the probability of profit. So if you have a probability of, let's say, 70%, you have X amount of profit potential. When this probability of profit increases, suppose if you go to a probability of profit of 99%, almost a certainty, this X will tend to decrease. So your profit potential will decrease as your probability of profit goes up. Likewise, as your probability of profit decreases, say let's say it goes down to 50%, then X, whatever percentage that is, tends to increase, and this will grow up. So there is this trade-off between profit potential and probability of profit. Again, something we will see in live examples in subsequent slides, but just so that you know, this trade-off exists, and we need to find that balance as far as profit potential and probability of profit is concerned. And then the final trade-off is between the rate of the return on investment, the ROI, and the value of the individual trades. So now this is slightly complicated in terms of understanding. So ROI, as we know, is a combination of the number of successful trades multiplied by individual returns, right, on those trades. So as the value of your individual trades increases, the probability of success decreases, as we saw in the previous trade-off, right? And therefore, overall, because of the law of large numbers, what we discussed in previous videos, the overall rate on investment decreases. So if you want to increase your rate of return or rate of return on your investment, then the per trade value should be reduced, thereby increasing the probability of success and overall return on investment increasing. So let's have a look at how this works out in the real world situation. As we said, calls and puts are the building blocks of strategy of your option strategies. So let's have a look at a single leg strategy of the long call, and we will see how this works in the real world scenario in subsequent slides. Okay, so when we're looking at a long call, we have a strike price at which we get into the trade. Now this is defined by this selection is therefore defines your total risk and your profit potential. Now, by selecting the strike price, you can either reduce your risk and thereby reduce your profit potential, or you can increase your risk and thereby reduce your and thereby increase your profit potential. So we'll see how that works out. Okay, well, very quickly, as your strike price shifts from at the money to in the money, the amount or the premium that is there goes up, and thereby increasing your risk. But since it is in the money, your probability of profit goes up, and therefore that trade-off needs to be balanced right there. Okay, so we look at it in the next slide. We'll jump onto the to the broker platform and see how this works out in the real world scenario. In the Opstra platform, the Defined Net Securities platform, and we click on Builder to understand what this call option strategy will look like in the real world. So we're looking at building a strategy around Nifty. Why Nifty? Because that's just the default here on the platform, and frankly something we trade actively in here at the income option as well. So why not the Nifty? So we're going to go ahead and jump into the options chain to pick a strategy that gives us a good risk to reward ratio. Now remember, buying a call option, the cost of the call option or the price of the call option depends on whether you're buying an in the money, out of the money, or at the money call option. And likewise, the in the money probability will change depending on whether you're buying an option which is already in the money, or you're buying something which is technically out of the money. So we look at both of these strategies to really understand how they're working out as far as the math is concerned. So we'll start with an out of the money call option. So let's go ahead and look at this strategy right here on the 19,900 call with an expiry for the 26th of October. So I go ahead and put this 19,900. I click on this and it says buy or sell. I want to buy, and there you have it. I've placed a position for a long call strategy. Now when I go and have a look at the risk profile diagram, here's what I see. As anticipated, we have a maximum loss of 2,330, basically 46.6 rupees into the lot size of 50 for the Nifty. So 50 into 46.6 is roughly 2,330 rupees. That's my maximum loss. If the market stays where it is, goes down, or goes up as high as 19,900, I am still losing money, and that loss is 2,330 rupees. And the probability that the market will actually go above 19,941 rupees, which is where I start making money, actually 19,946 rupees, which is where I start making money, is 22.18%. As you can imagine, there is very low chance that the market is actually going to go as high as that. So even though my maximum profit is undefined, the market can actually go to infinity. As you can see, the probability of it moving just beyond 19,940 is just 22.18%. What does that mean as far as the numbers are concerned? When I jump into my risk management sheet, what we have, which is part of our this sheet is part of our risk management profile program, and what we do is we go ahead and put in an investment of notional investment of 1 lakh, and the risk per trade we set it as 1%. Typically we range between 2 to 3% at the max, but 1% for this example. And let's say that we are looking at a 1:1 risk to reward ratio, which means that for this trade to be successful, I'm expecting a loss of 2,330, but at the same time I will consider a success if it goes beyond 19,900 and let me see, 19,994. So roughly at 9 to down, I will make a profit of 2,320 rupees. Now, if the market does move, and that blue line is what it shows, what will happen to the profit or to the mark to market if the market moves today up and down this, but we look at that in subsequently.
but let's assume we're looking at it to close at 2003 rupees, where you'll make 2820 rupees. That is a risk to reward ratio of 1:1, which means for a potential loss of 1000 rupees, I have a potential profit of 1000 rupees as well. And as we saw, the success ratio is 22%. What does that mean in terms of trades? So let's say I take one trade a week for the 52 trading weeks that we have in a year, which means I will have 12 successful trades giving me a loss of 12,000 rupees, but 40 loss-making trades, which will give me 40,000 rupees of loss, giving me a total loss of 20,000 or net loss of 28,000 rupees, which is a minus 28% return on my capital. Now, obviously, this does not make sense as far as my risk-to-reward ratio is concerned. And as you can tell, and as we saw in earlier slides, this trade-off between probability and the ROI is very real. So as the profitability increases, you see there is a potential unlimited profitability in this potential of profit over here. The probability of that happening has reduced significantly. Okay. Now, on the other hand, if I was to look at, as we said, we look at this as a as an out of the money strategy. If I look at an at the money strategy, let's look at the same strike price, let's look at the same expiry, but right now we're going to buy it at the money, which is 19,700. So I'm going to go and spend 131.25 rupees and buy this call option for 19,700, 26th October 2023 expiry. I add that to my position, and I go and have a look at my risk profile diagram. And as anticipated, we have that maximum loss, which is set at 6,562 rupees, 131 rupees multiplied by 50 units, of which is lot size for the Nifty. Now, what happens then is that your profitability, even though you are buying an at the money call option, your profitability, you don't become profitable till the market reaches 19,834, because you have to make up this cost beyond the current price. And as you can see, the probability of profit is still a dismal 33.32%. For us to make profit on this at a 1:1 ratio, the market has to, the risk-reward ratio, the market has to move not to 19,830, but all the way up to 19,955, right? Or even more, 19,968 rupees. At that price, we're looking at 1:1. So you can imagine, for it to move from here to here, it is 33%. From moving from here to here, it becomes even less. The probability of profit becomes even less. So as you can see, this is the trade-off that we're talking about. And when I reflect this into my risk-reward or risk management sheet, you will see an even worse performance, because now your risk per trade has increased from 2,000 rupees, what we saw in the previous example, to 6,562 rupees, increasing my per trade risk. Okay, so hopefully you find that you can relate that in the real life to what we just saw in the previous example.
Now, on the other side of the long call is the short call. Now remember, to get into a long call, we needed to buy to enter. So we put up an amount of premium which acted as our risk, and thereby guided what we're doing in terms of the profitability as well as the probability of profit. In the single short call, it changes. Now, as you know, for shorting a position, you are selling to enter. So you sell the trade to enter, and as a result, you have a net credit. You receive credit for this trade. This credit is equal to your profit potential. By limiting this profit potential, you will see, as we go into the broker platform, you will see how the probability of profit goes up, because we have limited the amount of profit. Yes, there is an increased amount of risk now, and that has its own problems, but because of a limited profit potential, you are now increasing your probability of profit, and we'll see this, as I said, in the broker platform as well.
To Opstra again, here at Definet Securities, we go back to Builder, and this time we're looking at the short call option strategy. What does that look like, and what impact does it have on our risk reward or risk management system? Specifically, how does the math, the calculation look like? What does it look like once we have put it all in place? Now remember, the call is we are looking at going when you're going long a call, we are bullish, and therefore when you're shorting a call, we're expecting the market to go down. So again, looking at the 19,900 call strategy. This time, of course, we're looking at shorting this stock. Now, the in the money probability for this strike price is 29.6%, which means the out of the money probability, the probability that this strategy, this strike price, the market does not go beyond 19,900 is 70%. So when we add this position, the short call position on the 19,900 call for 26th October 2023 for the Nifty, this is what it looks like. Now, jumping over to the risk profile diagram, you'll see that it's a mirror image of what we saw in a previous slide, where we looked at the long call option. Right now, in this situation, as long as the market stays where it is, goes up a little, or even goes down, you are going to make this 2,438 rupees. Now again, technically the maximum loss is undefined. It can go anywhere up to that level. Okay, now, and this is where the challenge comes in. 77.15% of the time you're going to make this 2,438%, but the balance 23% of the time you don't know how much you're going to lose, so your risk is undefined. But as you can see, this strategy makes a lot more sense, mathematically speaking, a lot more sense than your long call strategy. Okay, so let's plug this into our risk management sheet and see what it looks like. Again, we have that 1 lakh rupees as a capital. We are taking 1% risk per trade, giving us a risk to reward ratio, a risk of 1,000 rupees. Now, before we set the risk to reward ratio, remember this is an undefined amount. So we will come back to the risk reward ratio. But let's assume that right now we're looking at a 1:1. With a 77% chance of success, we have a whopping 30% return on our investment of 1 lakh rupees. We have 41 successful trades giving us 41,000 rupees and 11 loss-making trades giving us 11,000 rupees of loss. However, and here's the problem with the short call strategy, this risk can go as high as 10,000 rupees and can wipe out, or even 40,000 rupees, and can wipe out this entire profit. Right? For example, if the market was to go simply move over here to, let's say, the 20,183, a movement of about 400 points in about 2 weeks, then you are this strategy is going to make a loss of 11,712 rupees. Can that happen 3 or 4 times? Yes, because there is a probability that of 23% that this strategy is going to be unprofitable, and it is those black swan events which can never be predicted that can cause serious damage to this strategy. Now, however, if I was to choose between the short call strategy and the long call strategy, you can see why the short call strategy makes more sense than the long call strategy. Is there a better way to do this? Yes, there is, and we'll discuss that in the next slide.
So does that mean that we are plagued with either a low profit potential or a high risk? No. This is where the more advanced strategies come in. The multi-leg strategies come in. So, for example, in the previous one, in the previous slides, we looked at the short call and the long call. By combining these two, shorting a call at the same time going long on a call, buying a call, you're able to combine a strategy, an advanced strategy called the call credit spread. Now, why is it called the credit spread? Well, it is a call. You're using the call option. You're creating a credit. You receive net credit because you're a net seller of options, and it is a spread because you are spreading your profit between two positions. Now, the short call side of things is represented by this part of the profile, of the risk profile, and the long call is represented by this side. Now, which means what? Which means that your profit is limited, so limited profit. At the same time, your risk is also limited, right? So limited risk. So this is a limited risk, limited profit strategy. Now you'll see in the next slide, you'll see as we jump into the broker platform, how this translates into a much better probability of profit. At the same time, we are able to manage our risk and create a more sustainable trading system. Okay, so let's have a look at that.
Back here again in the defined securities option platform, and what we're going to do is we're going to combine the two, as we saw in the previous slide. We're going to combine the two sides of a call option, the long side as well as the short side. So let's see what it looks like. As we saw earlier, it makes more sense for us to be net sellers of options. So when we go ahead and sell this 19,900 call, we add a significant amount of probability of success to our position, 76.71% in this case. But as we saw earlier, the problem with this strategy is that the risk is undefined. So any one bad week or one bad trade can wipe out all our profits. So this is not a desirable strategy, even though we want to be net sellers of options. The shorting a call is not a feasible strategy in the long run. There is no hedge to this strategy. So let's see how we can provide that hedge. We go back into our options chain, and this time we go down deeper into the money, out of the money, and buy the 20,000 rupee strike price call option at 26.85, thereby creating that hedge for us. Now the combination of the two is what we look at, what results in the risk profile diagrams changing significantly. As you can see, the probability of profit stays similar. It was earlier 75%, now it's gone to 73.86%, about 74%. But the risk profile has changed significantly. A maximum profit of 1,092, but a defined loss of 3,908 rupees. Now this is a much more feasible situation. If I am able to deploy the strategy on a number of bases, this is a hedge strategy, and therefore it creates a significant amount of edge, of profitability and advantage for me in the long run.
Now we can create even more advanced strategies by combining two spreads. So on the right side of this diagram, this is called the iron condor, and on the right side of the right part of the iron condor is what we had as the call spread, the call credit spread. And on the left side you will have the put spread. So by combining these two spreads, you can create the iron condor. Now as you can tell, this is the call spread or the call spread side of the iron condor, and this is the put side, the put spread side of the iron condor. Now what is the advantage of this strategy? Now this strategy makes you maximum profit right over here. This is your profit potential, and makes you max profit if the market is range bound and it stays within this band of strike price. So this is strike price 1 and this is strike price 2. So as long as it stays between the two strike prices, you make your maximum profit. Now on paper this might not look very attractive, because you'll see that, you know what, I'm making profit only in a very narrow band. But as you'll see in subsequent videos, when we show you actual examples of this trade, you'll see how it affects your profitability in terms of increased probability of success, as well as the ability to repeat this regularly, and the market really favoring this kind of a strategy. Remember that most of the times historically, more often than not, the markets move sideways. So taking advantage of sideways moving markets in iron condor is a very popular strategy to take care of those sideways movements, to make sure that you're making profit even when the market is not trend based, it's just moving sideways during the week or during the period under consideration. Likewise, we also have the next strategy, which is called the butterfly spread. Now the butterfly spread is essentially the same thing as the iron condor. The only difference is that instead of having two strike prices, you only have one strike price, and this peaks at this. So the maximum potential, the profit potential, peaks at this strike price. Again, on paper it doesn't look so exciting, but when you actually see it in the real world, it looks more like this, where you are able to have a very small amount of risk on either side, but you are able to take advantage of a high peak, thereby increasing not just the peak profit potential, but also the profit range. The profit range therefore becomes this part of the diagram. This part of the strategy becomes your profit potential. Okay, so hopefully these diagrams, these advanced strategies, are something that have become clearer to you, why we use them and how we combine the basic strategies of long call, short call, and long put and short put to combine more to create more advanced strategies. And as we move forward, we'll go deeper into these strategies. So again, thank you for watching, and if you like this, if you have any comments, suggestions, we'd love to hear from you. Please do share them with us in the comment section below. If you like this video, if you love this video, do share it with other people, like-minded people who you think will benefit from these videos, and really spread the word, help us spread the word of what we're trying to do here at the Income Option. Thank you.